Germany, Europe's industrial powerhouse, is facing a problem it never wanted to admit. For decades, German companies relied on China for growth, cheap supply chains, and critical raw materials. But today, something has changed. China is tightening exports. Trade deficits are exploding. And German politicians are sounding the alarm. Our economy is vulnerable. We are too dependent. In this video, we'll break down why Germany is rethinking its relationship with China, what the hidden risks are, and how this could reshape the entire global economy. Stay with me, because what's happening behind the scenes is much bigger than trade. It's about power, control, and the future of global wealth. For over 20 years, Germany and China have been tightly connected. Germany needed cheap manufacturing, and China needed high-quality German machines. German companies like Volkswagen, Siemens, BASF, and BMW built massive operations in China. Very quickly, China became Germany's top trading partner, a key market for its luxury cars, and the primary source of critical industrial materials. German factories, especially in the automotive, engineering, and chemical sectors, became deeply tied to Chinese supply chains. But there's a hidden layer here. Up to a third of Germany's imports from China involve products where Germany has almost no alternative suppliers. We're talking about rare earths, battery components, high-tech machinery, and electronic parts. These weren't just imports, they were dependencies. Recently, Germany was hit with a wake-up call. China started limiting exports of critical minerals. These are the materials that power electric cars, wind turbines, and robotics, the very heart of Europe's future industries. At the same time, Germany's trade deficit with China is exploding. The gap is now projected to hit a record high because German exports to China are falling while Chinese exports are surging. Germany realized something dangerous. If relations deteriorate, if China restricts more exports, if geopolitical tensions escalate, German industries could grind to a halt. Politically, the tone shifted as well. Germany's chancellor stated it clearly: "We are susceptible to blackmail when we depend too much on one country." That's when Germany initiated a total rethink of its strategy. Germany's new approach isn't about cutting ties with China. It's about reducing the danger of being too dependent. The new strategy is called de-risking. Its key features include redesigning supply chains. Germany is now actively seeking alternative sources for rare earths, battery materials, and electronics. Some companies are moving production to Eastern Europe, India, and Southeast Asia. Next is tougher screening on Chinese investments. China can no longer easily buy into German critical infrastructure or technology sectors. Germany is also tightening its export controls on sensitive tech to prevent forced technology transfers. Finally, there's EU-wide cooperation. Germany is working with the rest of Europe to build strategic independence in chips, batteries, and energy. This is Germany's way of saying, we want to trade with China, but not rely on China. Germany learned that dependence on a single partner, even a friendly one, can become dangerous. Here are the core risks it faces. First, supply chain disruption. If China restricts materials or parts, Germany cannot simply replace them overnight. Second, a loss of bargaining power. A massive trade deficit gives China leverage that Germany doesn't want to admit it has. Third, political exposure. In any geopolitical conflict, Germany's economy becomes a pressure point. And fourth, industrial vulnerability. German champions like Volkswagen, BASF, and Siemens rely heavily on the Chinese market. If China changes its rules or tightens regulations, these companies risk losing billions. And the transition away from this dependence will be slow. Studies show that even with a de-risking strategy, it may take decades for Germany to fully diversify its economy. In short, Germany built an economic miracle on global cooperation, only to discover its foundation wasn't entirely stable. But Germany isn't panicking, it's adapting. Here's how. German companies are expanding operations into new markets like India, Vietnam, Mexico, and Eastern Europe. The EU is also investing heavily in building its own capabilities, including battery factories, semiconductor plants, rare earth processing facilities, and clean energy infrastructure. Germany is also strengthening ties with other democracies, pushing for partnerships with Japan, South Korea, Canada, and Australia. And for the first time in decades, Germany is doing what it has long avoided: industrial planning. The government is taking a more active role in guiding the economy towards strategic goals. The message is clear: a strong Europe cannot rely on a single supplier. Germany's rethink is not just a German story. This will shape global supply chains for years to come. Here's what is coming. More countries will likely follow Germany's lead and reduce their dependence on China. In response, China may seek friendlier partners, expanding its influence in Africa and other parts of Asia. Europe could develop stronger internal manufacturing hubs to compete on a global scale. Ultimately, global trade patterns are shifting. The world is entering a new phase of economic blocs and strategic alliances. This is the real beginning of a new era. Germany once believed that economic cooperation created stability. But the world has changed, and so has the balance of power. Whether this shift makes Europe stronger or more vulnerable depends on the decisions being made right now. One thing is certain. The relationship between Germany and China will shape the future of global wealth, technology, and trade for decades to come. If you want more breakdowns like this on global money flows, geopolitics, and the forces shaping our world, make sure to like, subscribe, and turn on notifications. Thanks for watching.